a nice example. So let's say we were right here. Let's say we were right here. Now look at this little bit of price action. Okay, now if you look at market structure this way, this is going to be very, very high probable. What's this? A stop hunt. A stop hunt and a break of structure, right? A break of structure. Stop hunt, break of structure. If it gives you a stop hunt and a break of structure, this becomes a strong low, right? This becomes a strong low. How do we know this strong low has created a weak high? I told you, you have to get a break of an intermediate term swing low. Look at this, three candle formation, three candle formation, and a three candle formation. So now they have created a higher high, and here we have the break. See that? So here is our trading range from here to here. Okay, a bullish QM is here, and a bearish QM is here. See that? A bearish QM is here. So why is price dropping back down into a discounted price? What's the other reason? To take out the internal range liquidity. What's the internal range liquidity? The swing lows that is resting inside of the trading range, right? That is the internal range liquidity. So what happened? Came back down, cleared the internal range liquidity. So when price clears that out, where are we expecting price to go next? External range. See that? Yeah, external range. What happened? Right into the targets. See that? That's how we take a range high and a range low, like this. Okay, this becomes your trading range. Can you understand that? This break, yeah, this break is the most high probable break, because now as soon as price goes above this, if you go to something like a 5 minute, for sure you can see breaks here. You can see that. For sure you can see breaks here. But what was your current trading range when price was right here? When price was right here, your current trading range was from here to here, right? Can you understand it? On a lower time frame, your trading range, yeah, is from here to here. So what if they decide to respect that and go back up? So if you take a sell here, you will get stopped out, right? That's the thing. That's why I told you on the same time frame. Only once you get this, you can confirm the trading range. Okay? Is it clear now? Okay, so let me delete this. So yeah, something like this is what you want to see. A swing low getting broken. Okay, a swing low getting broken. That is what confirms the trading range. Now let's say like this cannot be taken as a break of structure. Why? Never created a higher high. Never created a higher high. Okay. Yeah, might be an inducement on a lower time frame. You can buy it from here. Okay, no problem with that. Like this, like because what's a QM? A QM is something like this. A bearish QM is a higher highs, higher lows, higher highs, and a lower low, right? That is a bearish QM. So this is not a higher high, right? This is a lower high. It has to create a higher high and then break. Then this is your trading range. Okay, it makes sense, right? I hope it's clear. Yeah. Now, look, the thing is now the most common mistake people do is they will take this as the low, and as soon as price breaks out of this high, they will take this as the low, high of the trading range and draw their discount and premium from here, and then expect that then price will do something like this and it will go like this. Then they will be like, oh, this went from a, yeah. Yeah, that's the thing. Then you will not get the proper discount and premium prices. Then everyone will be like, oh, it went from a premium price. But no, it did not. It went from a discounted price of this trading range. See that? Price is fractal. Price is fractal. So what you can do is until the higher time frame external range liquidity is taken out, buy it from these areas. You can stack up entries using the lower time frame trading ranges. See, you had a break here. From here to here is the trading range. You could have bought it here. Then you had a break here. From here to here is the trading range. You could have bought it here. See that? So you had a break here. I told you after every single break of structure, a new trading range is made. So you had a break here. From here to here is the trading range. You could have bought it here. You had a break here, here to here, bought it here, bought it here. See that? That's the thing. Okay, you could just stack up entries using the lower time frame trading ranges. Okay, so is it clear? Yeah. Okay. Then let's say something like this is happening. let's say price is moving back up, and you had a bearish QM formed here before a new higher high is made. Okay, now this is when things get interesting. Okay, now what is your current trade in range? Okay, that's the thing. If you know your proper trade in range, okay, that is what's gonna give you the proper bias. Okay, now what is your major breakout structure? It's here, right? And that breakout structure is still bullish. So this little breakout structure cannot say that GU is gonna be bearish. No, because your higher time frame breakout structure is still a bullish one. Okay, it's still a bullish one. So look at this. The higher low is supposed to create a higher high, right? The higher low is supposed to create a higher high. So if this is the higher low, it has to create a higher high, right? It has to create a higher high. But what happened? Failed. Okay, this breakout structure is the indication that this low has failed to create a higher high. The low has failed. It's a failure swing. So our current trading is still from here to here. Okay, from here to here, not from here to here or from here to here. It is from here to here. See that? So this low has failed to create a higher high. So if it fails to create a higher high, this becomes a weak low. See that? Then it becomes a weak low. Now you cannot expect confirmation entries from these areas. Why? It is a weak low. It is a weak low. So you can't buy from a weak low. You're going to take this as the liquidity or as the inducement now, and you're going to look for something below that. See that? This is the reason why people get stopped out. They will look for confirmation entries from these areas like this, and then price will stop you out on the confirmation entry itself. Price will do this. See that? You would have seen this happen. Okay, so that's the reason. That's the reason. Okay, so basically you're trying to buy from a weak high. So you get stopped out. No wonder why you're getting stopped out. Okay, now if it's a weak, I'm sorry, it's a weak low, not a weak high. Okay, yeah. So if it's a weak low, it's obviously getting taken out, right? It's weak. It's weak. Okay, now why is this liquidity once again? Not only because it failed to create a higher high. Okay, if you look at this, it's a trend line. Okay, it's a trend line. And this might be, yeah, let's mark that out as liquidity, and this might be a broken resistance turning into support. See that? This might even be, yeah, this is internal. Okay, internal, still inside of this trading range. Okay, yeah, same thing. And see, from here to here, this might even be a Fibonacci retracement, like the 78.6. You know how famous these levels are, right? Golden ratio, 61.8. So everyone will be buying from these areas. And you know the classic smart money setup, right? A stop hunt, breakout structure, RTO, the return to origin. You know that setup, right? Stop hunt, breakout structure, RTO. So this might even be that. See this? A stop hunt, breakout structure, RTO. People might think this is their return to origin, and then everyone will start chasing this move because no one wants to like miss out on a good move, right? Everyone will start chasing it. Okay, and see all of this liquidity getting built up. Okay, but we are gonna look for something below that. We're gonna look for something below that, like this. Okay, then they can do something like this because they know that everyone will be looking to buy from here, but it's weak. It's weak. Okay, so price can come back down, sweep all of this liquidity now into this point of interest. Okay, now what is your current trading range? It's from here to here, right? So where are we currently at? We are in an extremely discounted price, right? Extremely discounted price. Look at that retracement, like a 90% retracement almost. Okay, so that's an extremely discounted price. Okay, extremely discounted price. So when price comes into extreme levels, what happens? They do not want the retail traders to enter here because that is a very nice pricing, a VIP pricing for the institutions. Okay, because this low is protected too, right? A stop hunt and a breakout structure. So that's a strong low. It's protected. So look how far, look how close they came to that protected low. So they do not want to spend a lot of time here. So once they get here, that's a VIP pricing for them. They will quickly move out of the trading range. These moves will be very quick, like this. Okay, so then you have a breakout structure. This becomes your low, and this becomes your high. See that? So this is the new trading range. Can you understand that? Okay, so everything that happened here is, what's that? Internal structure. Do not get confused by this internal structure. Okay, so this is your These are your proper swing points here to here and here to here. So same stuff. What are you going to do? Okay, look for discount and premium, wait for price to get into a discount, and wait for all of the drama to end by below that. That's it. Okay, and make sure you have a look for the inducements too. Okay, the inducements too. So can you understand this? Yeah, let me know.
Yeah.
I hope it's clear. Okay, so this is a bullish market, and then same thing in a bearish market. Now let's go to a bearish market. Okay, now price is in a downtrend. Okay, now the price is in a downtrend. So what are we going to do? After every single break of structure, a new trading range will be created. So what is your current trading range from here to here? Okay, so like a normal market, what would you do? If you want to sell a product, you're going to wait for the price of that product to increase, right? You know that you're going to wait for the price of that product to increase. So same thing here. You're going to wait until it goes into a premium price now. Okay, until it goes into a premium price, because it's like a normal market. Okay, into an expensive price. So that is anything above the equilibrium level. Okay, anything above the equilibrium level. Now it doesn't have to go into the 61.8 or 70.6 or 88.6 or nothing like that. If it just taps the equilibrium, that is enough. Okay, that is enough. So keep in mind, a high probable bearish point of interest will always come from the equilibrium or else anything above that. Okay, from the equilibrium or else anything above that. Okay, so we are not going to look for anything in a discounted price to sell from. Like for sure they can do this, but it will not last long. Okay, so you can take your intraday trades from these areas, no problem with that, but you can't hold it to these lows because you cannot swing a sell from a premium, from a discounted price. Okay, it has to always come from a premium price. Okay, so yeah, keep that in mind. And yeah, discount and premium and all of that stuff. So price can go up like this. Now,
But
what's the
most of
other
the time,
reason?
but most of the times when I see in lower time frames and also in
Okay.
higher time frames, most of the time price will not coming to those premium levels.
Okay, maybe you haven't marked it right because I'll show you. Because it always comes at least into the equilibrium. Okay, at least into the equilibrium it will come. Okay, so I'll show you. I'll show you. Yeah, sometimes they can always do what they ever want to do. Okay, whatever they want to do, they will do it. Okay, but yeah, most of the time it will come into discount and premium prices. Okay, like 90% of the time it will. Okay, so I will show you examples. Don't worry. Okay, but yeah, first I'll explain this and then I will show you the examples because after this, let's get straight into charts. Okay, yeah, then it goes into a premium price. And what's the other reason they're going back up is to take out the swing highs, the internal range liquidity inside of this trading range. See that? So a bounce in a bearish market is a hunt for buy stops. Okay, so they go up, clears out the buy stops or else the internal range liquidity. And where will they go next? External range liquidity.
Yes.
Okay, from internal range to external range, or from the after taking out the buy stops they will go after sell stops. Okay, they will go after sell stops. So that is what happens. That is what happens. Now, how do we confirm the new trade in range? Okay, so price has to do this. Okay, so let's say we had a strong high created, so price has to come back down, and once you get a break below this low right here, that is what confirms the high of the trade in range. Because why? We have a bullish QM. Okay, but how do we confirm the low? You have to get a bearish Quasimodo. I'm sorry, we have a bullish, a bearish Quasimodo here. Yeah, now you have to get a bullish Quasimodo for you to confirm the low, like this. See that?
Yeah.
Then this becomes your new trading range, discount and premium. Okay, once again discount and premium, and wait for it to clear out the internal range liquidity. And now since price is fractal, you can do something like this too. Now let's say price is falling back down. Let's say you had a QM here. What are you going to wait for? On a lower time frame, you can use this as the trading range, discount and premium. Wait for the drama to end, buy below the inducement, somewhere around here. Where are you holding it into? Into the internal range
Equilibrium within the
liquidity.
time frame.
Yeah, exactly. Exactly. Okay, the equilibrium is your safest target, right? Because they can just tap the equilibrium and then melt. That can happen. So keep in mind the equilibrium level is always your target. Okay, that is always your target, or else you can just hold it into this internal range liquid. So let's say price is going up. So you can do this ping pong stuff. And after clearing out the internal range liquidity, when this counter trend gets broken, okay, a bearish QM is formed. Wait for this, sell above that, and yeah, it will drop. See that?
Okay.
So then you can do this ping pong stuff up and down if you know the proper trading range. And remember, price is fractal. Okay, price is fractal. So you can sell it from here to here. You can buy it from here to here. Okay, once again, you can buy it from here to here. You can sell it from here to here. All of that stuff is possible. Okay, only thing you have to do is mark out the proper trading range. Okay, so I'll show you. I'll show you how to do that. So can you understand this? Yeah.
Yeah.
Mm, okay. Let me refresh this. Yeah, I think because I have the $5 trading view premium thing, it's the free trial. That's why it's laggy. Okay.
Okay.
So now let's see what's happening. Okay, let's say price is coming back down like this. Let's say we had a bullish QM formed before a new lower low is created. Okay, so what's your trading range now? Now you can't use from here to here as the trading range. No, because why? It's weak now, right? It is weak. It is weak. Like for sure, you might get reactions. Okay, because why? We have liquidity being fed into that point of interest. So you might get reactions, but it's not gonna hold, it's not gonna last long. Okay, it is not going to last long because why? It's weak, right? It is weak. Now let's now, if this is a 4 hour time frame, for sure you can take intraday trades from here. Okay, for sure you can take intraday trades, but keep in mind you can't swing them because you're trying to sell from a weak high. Okay, why is it weak? It never created a lower low. It broke. It failed to create a lower low. This is the indication that it has failed to create a lower low. Can you understand that? Okay, so if it fails, this will turn into a weak high. Okay, this will turn into a weak high. So obviously, if it's a weak high, it is liquidity. It's getting taken out. Now, why is it liquidity? Not only because it failed to create a lower low. Okay, these trend lines, okay, support turning into resistance, Fibonacci levels, okay, or is this top hunt breakout structure RTO? Everyone will be selling this, but we're gonna wait for this, okay, something like that. All of that liquidity, these trend lines forming, all of that. Look at how much of liquidity. Okay, a lot of liquidity is getting built up. So what we are gonna do is we're gonna look for something above that. Okay, we're not gonna look for confirmation entries from here. Look for a point of interest above that because it is feeding liquidity into this. Then price can come up, sweep this liquidity, and when price comes here, it's a VIP pricing for them, like I told you. Okay, because that's an extremely premium price, right?
Yes.
Extremely premium price of this trading range. So when they come here, they do not want the retail traders to enter the market with them. So these moves will be very quick. They will quickly move out of the trading range like that. Okay, so once you get this break, okay, so you have a new trading range from here to here now. Okay, so same stuff, discount and premium, wait for it to end. You can even hedge it until it goes there. Okay, or else you can wait until it gets here and then sell it. Okay, so this is pretty much what happens with market structure. Okay, do not get confused with them because this is internal structure. Like price can spend like days and weeks inside of a trading range like this. Inside of this trading range, they can spend like, yeah, even a month inside of this trading range. But once it gets into the extremes, it drops. Okay, this is what happens. So you have to know your proper trading range. Can you understand that? Yeah.
Yeah, I got it.
Okay. Then let's get into the charts. Now, what the fuck is? Oh, okay. I have I have internet. Okay. Now, once we no no not once we now as a smart money trader, okay, as an intraday trader, what's the highest time frame that you would look at? Like personally, what's the highest time frame you would look at?
Uh, Firstly, I will go to the 4 hour chart and mark the
Okay.
strong highs and weak lows and those
Oh,
kinds of stuffs. And I will go
okay.
to that's my maximum highest time frame.
That's the highest time frame.
Yeah.
Okay, but that's okay for intraday trades. That's gonna be fine. Okay, but you have to always start with the higher time frames. Now, when I say higher time frames, at least the weekly. Okay, at least the weekly or the daily. Now, for me personally, I will always start from the weekly time frame. Okay, I will always start from the weekly time frame. Why would I do that? Because like now when I say the weekly, I don't care about all of this. I don't care if the weekly is creating lower highs or lower lows.